Dr. Upton, if you would, please introduce yourself and let's dive into the work that you've done related to severance tax.
Sure. Good morning. My name is Greg Upton. I'm Associate Research Professor at the LSU Center for Energy Studies, and I was asked to share with you the work we've completed while studying mineral revenues in response in Act 4 of the 2018 Second Special Session, which of course is with Dr. Richardson. So before digging into the recommendations, I'd like to first provide a brief timeline of the work that we've done to date, even that preceding Act 4. Can y'all see the slides? Did you put them up? Thank you. In the summer of 2014, Dr. Richardson approached me about participating in an overarching tax study that he and colleagues at Tulane, Dr. Steve Sheffrin, who's of course here, and Dr. Jim Alm were conducting via the request of the legislature. I was asked to focus on the mineral revenues piece of that work, which was later published as a chapter of the book exploring long-term solutions for the Louisiana tax system. Then in the first special session of 2016, the legislature passed HCR 11, which of course you're familiar with, which created the Task Force on Structural Changes in Budget and Tax Policy. And in January 2017, the task force produced its final report. And I want to read one key sentence from the report that I believe describes the overall goal of the tax policy and something that we really took to heart in our report. Quote, "The tax structure should be fair, simple, competitive with other states, and stable over time, short and long term. These qualities are best achieved with taxes that are broad-based with low rates and that do not play favorites for or against a particular constituency." And so that's really the goal that we start with. Then during the second special session of 2018, SCR 4 was passed, becoming Act 4, requesting that we analyze the mineral tax laws in Louisiana and make specific recommendations to the legislature. The resolution laid out a specific 3-year timeline for this process. In the first year, we conducted dozens of meetings with stakeholders. This included industry associations, state government employees at both LDR and DNR, including Secretary Robinson, who's here today, academics who study tax policy, including Dr. Sheffrin, and dozens of people, including attorneys and private oil and gas companies, again, many of which are on this panel. In February of 2019, we released a status report that was provided to the Senate Committee on Revenue and Fiscal Affairs and House and Ways and Means, and was also made public on the Center for Energy Studies website. We presented at that time to the Tax Institute, the LSU Center for Energy Studies Advisory Council, among others. So it was made public and distributed. In the second year, we continued to receive feedback from stakeholders and began working on collecting data and conducting analysis for the final report of recommendations. This report was released in March of 2020 and was again provided to the committees, published publicly on the LSU Center for Energy Studies website, and has been provided to you here today in hard form and is also, again, publicly on our website. Our third and final deliverable requested by Act 4 was specific bills implementing these recommendations. So over the past year, again, we had meetings with LDR, DNR, LaMoga, LOGA, among others, and making changes to revised statute 47633, which is the primary statute around severance taxes, that would implement these specific recommendations. These strike and edit changes were provided to staff in November and have also been provided to you here today. I also made similar presentation to the one today to Joint House Ways and Means and Senate Revenue and Fiscal Affairs in January. So let's go through very quickly the goals of the analysis that we were given. So this is our starting point. So the first goal was to preserve or improve the competitiveness of the oil and gas extraction sector in Louisiana. Pretty straightforward. We want to preserve that competitiveness. The second thing we wanted to look at was decreasing or removing the difference in tax rates for oil and gas. And I want to read you, this has been something that's been discussed for years. And I want to read you an excerpt from a letter written by Mr. Bob Bauman in 2002, so almost 20 years ago. And at the time, he was executive director of the LSU Center for Energy Studies. And for those of you that aren't familiar, Mr. Bauman's a lobbyist for the oil and gas industry today. And I want to read this because it's still true today, many years later. Mr. Bauman says, quote, "The full severance rate on oil is 12.5%. This is the second highest rate in the U.S., and the effective rate is the highest." He then discusses Alaska, which is a bit of apples and oranges for technical reasons. Mr. Bauman goes on to say, "The Louisiana severance tax rate on oil is approximately 3 times that on natural gas. Louisiana is the only state that has such a large difference in severance tax on the two commodities. This is rooted in our history, and it is worthwhile to briefly review it. In the early 1970s, Governor Edwards doubled the oil severance tax to the current 12.5%. At that time, the price of oil was not market-based and was fixed, I believe, at $3 a barrel. In doubling the severance tax, Edwards knew, which he only later revealed, that the United States was going to raise the fixed price by $1. Thus, the oil companies would have to pay another 24 cents or so in higher taxes, but they would gross another $1 per barrel in revenue. The Edwardian logic being that both the state and the oil companies came out ahead. And so we know the political history of why we have this disparity in the rates for oil and natural gas. The question that Dr. Richardson and I tackled is there an economic reason in 2021 to have this difference? And as I'll say, in our opinion, there is no economic reason for this difference today. The third point we were asked to look at is to create an equitable system of severance tax exemptions on all wells, not just horizontal wells. And so, again, as I'll show you data here in a little bit, horizontal wells have received the overwhelming plurality of exemptions. I think actually the majority of exemptions in the state. And so the question is, should horizontal wells receive different tax treatment than, let's say, a conventional vertical well? And again, we know the political reasons for this. We can go back and look that up. But the question is there an economic reason in 2021 for that? And again, as I'll say, we don't see an economic reason for that today. And then number 4 is to hold constant or increase mineral revenues for the state. So we take bullet point 1 and bullet point 4 combined to state that we want to achieve what we call revenue neutrality. So the idea is that if the legislature were to implement this new proposed severance tax system, in the long run, it would bring in about the same amount of revenues if they didn't implement the changes. Of course, it's impossible to know exactly every year the exact dollar amount, but the goal is for in the long run to that balance. And then 5th, explore other reasons oil and gas production is fluctuating in the state and any changes that need to be made to increase that production. So I want to show here real quick a cross comparison of states in terms of Louisiana's overall competitiveness in terms of oil and gas. So on the left here, I show 2 studies. On the left here is a study done by Alan Pulsifer and colleagues. Alan Pulsifer was the late executive director of the Center for Energy Studies, and Mr. Bauman was actually a co-author on this study. And this was published in 1990. And they got together with a bunch of accounting firms, actually, who had oil and gas reserves in different states. And they said, okay, what if we were to drill this well in state A versus state B, what would be the overall tax burden? And so they looked at sales tax, corporate tax, property tax, severance tax. And what they find when it all shakes out is that Louisiana's sort of right in the middle of the pack. And if you ask Mr. Bauman about that today, he'll tell you the difference between Texas and Louisiana was well within the margin of error of this study. Then if you look on the right, this is a paper published in 2018 by Newell and Ramey. These are colleagues at Resources for the Future in Washington, D.C., so this wasn't directed at Louisiana. And they only look at property tax and severance tax. But again, what you see is that when you rank all the states, Louisiana's right in the middle of the pack there. We're right to the left of the median. And so the bottom line is that in terms of the overall tax burden, Louisiana is not a high tax burden. We're in the middle of the pack, and so we think that we're competitive in that regard. But this next slide shows the revenues that come from oil versus natural gas. And as you can see, on average over the last 5 fiscal years at the time that this was published, gas severance tax revenues were about $141 million a year. But the value of those exemptions was $133 million. When you look at, so the value of the exemptions almost equaled the actual revenues that came in from natural gas. When you look at oil, you see a very different story. First of all, you see an average of $417 million a year in revenues and $98 million in exemptions, meaning that even though more revenues came from oil, even just the dollar amount exemptions was lower. And this is primarily driven by 2 factors. Number one, the oil tax rate, as I just mentioned, is approximately 3 times that of natural gas. There are other technical differences, but that's the big driver. And then also the horizontal drilling exemption has primarily benefited the Haynesville Shale up in North Louisiana, and that was not by design, but that's just how events have unfolded. And so the bottom line is that, yes, you can look at the rates and they're different, but also when you look at the tax burden, after all these factors are taken into account, you still see that the tax burden falls more heavily on oil producers. Okay? So what are our recommendations? Number one, institute an equivalent volumetric tax rate for oil and natural gas with the rate to be established semi-annually. This is a mouthful, so let's go through each piece of this. First of all, equivalent. What does that mean? It means that the rate should be approximately the same for oil and natural gas. Volumetric. What does that mean? Well, in Louisiana, we tax oil on a value basis. And so you take the value that the producer sells the oil for, you subtract out transportation costs, and then on the difference, you will pay the 12.5% severance tax. And so, if producer A gets a little bit higher value for the oil than producer B, then that will be reflected in the severance tax. Also, if one field is far from market and has more transportation costs, again, that will be reflected in the severance tax. For natural gas, we tax at what's called a volumetric basis. So how that works is that once a year, the Department of Natural Resources does a calculation, and by the way, it's a very complicated and convoluted calculation that we recommend that you simplify. Mathematically, it simplifies to be very simple, but in the statute, it's very complicated needlessly. But nonetheless, at the end of the day, the calculation comes out to about 4% of the price in the prior year. And so every producer pays the same rate, volumetric rate per MCF or 1,000 cubic feet of natural gas. So if one producer has a little bit higher price than another producer, that's not reflected in the price. So this is sort of a trade-off we talk about in the report. When we talk to gas producers, no one really complains about this. They're like, yeah, it's simple. We sort of like the simplicity. We understand that it only updates once a year, and so if the price goes up or down, it impacts our tax burden in the short run, but the simplicity is worth it. When you talk to a lot of oil producers, as well as to the Department of Revenue, what you find is that it's more complicated to figure out the taxes for oil. And if you want to look at a case, it's Avanti versus Robinson, where there's disagreement with the Department of Revenue and producers over how you value those transportation costs, etc. So when I look at this, my opinion is just go to the volumetric rate. The simplification is worth it. Of course, that's just my opinion, though, after looking at it. And then with the rate to be established semi-annually. So we update that rate once a year. In some years, for instance, the big one was when the price of natural gas dropped, I think in 2009. I mean, it dropped precipitously in 1 year, and that really increased the tax burden in the short run. And so, you could do it every month. That's probably too often. Once a year, probably not often enough. And so, again, from talking to people, we think semi-annually or twice a year is probably sort of that Goldilocks zone there for updating that rate. Number 2, remove exemptions associated with horizontal, tertiary, and deep wells for new activity. And this for new activity is very important. So we want to sunset these exemptions, but we also don't want to change the tax burden on a company very suddenly that has already made economic decisions based upon that tax structure. So imagine you're a company that owns acreage in the Haynesville, for instance, and you have you've acquired leases, you've paid bonus payments, you've made long-term decisions to sell natural gas at this price, etc., and you're banking on that horizontal drilling exemption. We don't want to change the rules of the game for you really quickly. So what we've done in the statute is we've actually said that if you're in a unit that is currently using that exemption, you will be grandfathered out to about 2030 of using that exemption. But for new units, regulatory units, after the law date change, and I'll get into the timeline here in a minute, that exemption will not be there. And so again, it's the balance of sunsetting those at the appropriate pace. And then number 3, implement recommendations 1 and 2 simultaneously while maintaining this revenue neutrality with respect to the current severance tax projections. And our analysis suggests that you can get that tax rate down to 6%. So think about that. Oil right now is at 12.5%. So you can reduce that tax rate all the way down to 6%. What's the trade-off? Natural gas tax rate's going to go up to 6% and from 4%, and you're going to lose a lot of these exemptions. But you end up with a broad base, low rate, simple tax system. And then number 4, implement new severance tax rates on oil and gas production from new activity. And so what does that mean is that if you currently have a well that's producing, your tax rate is not going to change. We would implement these new tax rates only for new wells that are drilled. So again, if someone's already made the economic decision to drill a well and it's producing, we're not going to change the tax structure on that individual after they've made that economic decision. So after making these recommendations, we've received written comments from both LaMoga and LOGA, which Senator Reese said you've been provided today. And we've provided written response to these comments. But I want to highlight one overarching point that's been made repeatedly by stakeholders over the past 3 years. And the comment goes like this. People tell me, well, Greg, if we were to create a severance tax system from scratch, the system you propose makes a lot of sense. But the political reality is that proposing a tax increase on anyone will make it difficult for an industry association to support the proposal, even if the result is broad-based, low rate, and simple tax system aimed at bringing in the same amount of revenue for the state. Of course, I'm paraphrasing, a generic comment that I've heard. And what's important to remember is that this is a political consideration, not necessarily an economic one. And so we've addressed this very explicitly in the report. We say, this is 10.3.1, revenue neutrality. Any tax changes that are meant to be revenue neutral will by definition increase tax liability for some taxpayers and decrease tax liability for others. Therefore, a position that taxes must not increase for any taxpayer is inherently contradictory to the fundamental concept of broad-based, low-rate, and revenue-neutral tax reform. Tax reform that lowers taxes for some taxpayers and does not increase taxes for others will inherently reduce revenues for the state. In this specific context, leveling the tax rate for oil and natural gas will by definition increase the rate for natural gas and decrease the rate for oil. Producers that focus on oil will be impacted differently than those that focus on natural gas. And so this extends beyond severance taxes. If we want revenue neutral, broad-based, low-rate tax reform, this is a reality. And so the question I asked the legislature, and then I did in the joint committee a few weeks ago, what is the desire of the legislature? If broad-based and low-rate tax reform is the goal, this is an inherent reality of achieving it. The goal of this report is to inform you on how these goals could be achieved if they are indeed the desire, which is what the initial goals we were given. So real quick, this is the timeline of implementation, and then I'll conclude. So assuming that this legislation were to pass this summer, which of course is a fiscal session, what we recommend is to lag the enactment of that legislation 1 year. And so there, you can do that. You just put in the bill that this will become effective in 1 year. And that 1 year lag between passage will give LDR and DNR time to implement the changes. And in practice, the big change is going to be moving to that volumetric rate. So they're going to need to adjust the tax forms, et cetera, in order to do that. And of course, we've had meetings with Secretary Robinson and Secretary Harris about that. And then the new tax rate would begin and the exemptions would sunset 1 year after that, so July 1st, 2023. And so the logic there is that if I'm currently a company that's leasing land right now and hopes to drill, we want to give them enough time to finish up that project before suddenly changing the tax rates on them. And so, you don't want to delay too long, but you also don't want to change so suddenly that it impacts individual companies that have made economic decisions. And so this is the timeline that we've settled on that hopefully balances those two goals. So I've got the proposed reorganization here. I won't go through it just because it gets somewhat technical in nature, but you have access to that, and I'm happy to answer any questions. So thank you so much for having me, and can answer any questions you might have.
All right. Dr. Upton, thank you for your thoughtful research on this topic. I, of course, had the benefit of hearing from you in our joint Rev and Fisk and House Ways and Means Committee just a few weeks ago. And it is a complicated topic. It does point out areas where we have huge disadvantages to other states in terms of the rate of our severance tax. I think it's something that there's some energy behind trying to get after. I will tell the members that in your packet, as Dr. Upton referenced, we do have responses to the study from Louisiana Oil and Gas. We also have a response from Louisiana Mid-Continent Oil and Gas, and there's also a response behind that from Dr. Upton to those two entities directly addressing the letters that they had written. All of which is very important, because I think it's important that we do hear from industry. We do take into consideration how they perceive not only the study, but the potential impacts on their industry, and from all of that information, arrive at good policy. So with that, we would entertain any questions for Dr. Upton. Anybody that has a question, if you'll press the button on your mic, I'll be glad to call on you. Otherwise, you may get off nearly scot-free. Yes, sir. Mr. Robidoux.
I just want to make sure I understand the slide where we have the state-by-state comparisons. Because it's the proposals of revenue neutral, if we were to run the same slide data as it compares to the other states under the proposals that your study is suggesting, we would stay in the same slot on that graph?
That's exactly accurate, yes.
Okay.
So both of those, and this is a very important question. So as you can see, when you take oil and gas together, we're right in the middle of the pack. But if you look at natural gas only, we're going to be very competitive to other states. We have a lower tax rate on average. But if you look at oil, we're going to be less competitive. And so in net, our competitiveness would stay similar. But what you would do is you would pull oil and gas to both be of similar competitiveness to other states.
Okay. And again, I know I'm on the tax commission and not a legislator anymore, but so those charts were the data used in those charts were tax only. There wasn't any other external data that was used, right? That's just as a comparison of tax rates, not the overall climate that may exist in any of the states in other ways, legal or otherwise.
Yeah, that's accurate. So an example of that would be the unitization process here in Louisiana. A lot of experts tell me is actually more simple than in Texas. Okay, so that's an advantage that Louisiana has over Texas. But at the same time, other people will tell you that the litigation climate here in Louisiana is not as friendly as Texas. So those kind of factors are not taken into account. Only taxes, only the taxes, yes.
That's all. Thank you very much, Mr. Chairman. Thank you.
I was just going to ask, it seems that in some of the back and forth, and obviously there's a big picture dispute here between the companies that are primarily, shale gas producers and maybe companies that operate in South Louisiana, and those incentives don't matter as much to them. And I understand the back and forth in that. But it seems like in some of the back and forth in the letters, there was maybe some additional detail that y'all could model potentially. For example, they talk about, okay, well, Texas has a lower sales tax rate. Well, that's true, but they also, tax downhole services and certain things that Louisiana does not tax. Same thing on the property tax. The mention was we don't have the reservoir tax, and I think the response from some of the oil and gas groups was, yeah, but we sure still pay a whole lot of property tax on that wellhead. Has there been any analysis of, take a comparable well in Louisiana, take a comparable well in Texas, and try to model and be able to intelligently answer, kind of those 2 points? That might be useful for the overall process. And then the other thing I would say is it seems like they're making a valid point about transportation marketing costs and those sorts of things. Did y'all, when y'all looked at your study metrics, obviously oil down in southern Plaquemine Parish that, you have to, I don't know, take a truck and a barge and a this and a, the value of that oil to a producer is significantly less than one, gas right next to the Henry Hub or oil next to the St. James terminal. What is the long-term implication of not having those kinds of deductions to outlying areas? And so it just seems to me, did y'all, take those comments and kind of come up with a model that answers them?
Yeah, sure. So on the transportation cost, interestingly, we went and looked at data from Texas and North Dakota, for instance, where you actually have wellhead price data for natural gas. And when you look at that, you actually see that the price difference that people get for natural gas is more than for oil. Okay? And right now, currently in Louisiana, we already tax natural gas at a volumetric rate. And I don't think there's been anyone who's told me, oh, we should move to a value basis there. So the question becomes, well, should we move to a volume basis for oil? And in the report, there's an entire section where the Department of Revenue gave us data on the price that individual producers received based upon their severance tax payments. And we looked at the dispersion of those prices. We calculated what the dispersion might be. And we also answered questions, do larger fields, do larger producers get higher prices than smaller producers and smaller fields? So yes, we looked into that in great detail, and there's an entire section in the report that highlights that. Whether or not that trade-off is worth it, and we call it in the report, by the way, an inherent trade-off. That's just a question, right? That's a question for individual companies and individual legislators to look, and it's a judgment call. In my judgment call, when I look at it, I think the simplification's worth it. But again, someone could look at the exact same data and have a different opinion of that. In terms of all of the other taxes that go into oil and gas in comparison across states, no, we have not. It would be very difficult. We would need to go in and look at similar to the study done in 1990. In fact, I even talked with Mr. Bauman at the very beginning about replicating that study. It just becomes complicated, quite frankly. So what I did is I just called different tax attorneys, in particular some in Houston that do severance taxes in all the different states. And I just asked them, I said, is it a fair comparison when I show them this chart here? It's like, is it just fair in general that the tax burden of oil is more than that of natural gas in Louisiana? And every one of them told me, yeah, of course it is, right? The rate's 4 times as high or 3 times as high. Yes, there's the other technical differences. And then I also asked them, is it also fair that the burden in net is probably similar when you take all those into account? And I had several accountants tell me, yes, that's also reasonable. So that's the extent for which we looked into that second piece.
And then my last question is, I think, unless I'm misremembering, Texas has basically the equivalent of a horizontal well exemption for gas via the high price gas exemption. They don't have anything, I don't believe, similar for oil. But isn't in most of the shale markets the high priced gas exemption operates similarly for gas purposes?
So in Texas, they have a 7.5% tax rate on gas. We have 4%. So that's the first thing. Then they have what's called a high cost well exemption. And how that works is that a producer, they report how much it costs to drill that well. Texas, the state government, takes all that data and they produce a distribution. And if you're in the higher part of that distribution, you get a larger reduction in the sales tax rate, or sorry, in the severance tax rate. If you're in the lower part of that distribution, you get a smaller reduction in that rate. And so when I talked with one accountant in Houston who does this across all the states, he told me, he said, oh yes, he said, the Texas policy is a really great employer for accountants. You know, if you want to stimulate the accounting profession in your state, you should definitely implement that high cost well exemption, similar to what we do. So yes, they have a high cost well exemption. Yes, it's only for gas, but their baseline rate is twice as much as ours.
Okay, thank you very much. very much.
I just have a question. In your research, did you ever get to why there is the difference between oil and gas in terms of 12% of value, 12.5% of value, and 4% of volume? Does it have anything to do with the BTU content of the different commodities?
Yeah, so this is a really great question. So it goes back way historical. So it used to be that there was a fixed rate for both oil and gas. And then at some point when there were interstate price controls, et cetera, and then at some point in the early 90s, there was a lot of disagreement over how you value that gas at the wellhead. It's just more complicated to value it because of transportation costs and everything else. And so the agreement that was reached at that time was to simply move to a volumetric rate, but that moved up and down with the price. But because there wasn't the difficulty with valuation of oil at the wellhead, that's when it diverged to doing oil on a value basis and natural gas on a volume basis.
But the variance in rate?
Oh, yes. So the variance in rate, so that goes down to the 1970s with what I read from Mr. Bauman. And so, of course, I wasn't around at that time, but how Mr. Bob describes it to me was exactly like it is in this letter. So he says in the early 1970s, Governor Edwards doubled that oil severance tax rate to its current 12.5%. At that time, the price of oil was not market-based, but was fixed. At the time, he says he believes $3 a barrel. And so in doubling the severance tax, Edwards knew, which he only later revealed, that the United States was going to raise that fixed price by $1. Thus, the oil companies would have to pay another 24 cents or so higher in taxes, but they would gross another $1 per barrel in revenues. And so the Edwarian logic being that both the state and the oil companies came out ahead. And so that's in Mr. Bauman's words. And actually in Revenue and Fiscal Affairs, House Ways and Means, Mr. Bauman came to the table and actually discussed a little bit of that history. He knows it. He was there.
So
when all
BTU
this
has nothing to do with it, is what you're saying.
That's correct. So it's a really interesting question because at the very beginning of this process, some people said, well, maybe we should move to a BTU basis for natural gas. And so we actually looked into that and actually went. Literally, I had a company bring me out to the wellhead and show me how the measurements were. We talked to a bunch of different accountants. We considered that very seriously. And we walked away thinking that was infeasible for technical reasons of when those measurements are made, et cetera.
Gotcha. That's it. Thank you.
Yeah.
Thank you, Mr. DeQueer.
Thank you, Mr. Chairman. Good to see you, Dr. Upton. I know we've worked together on a number of things and appreciate all the hard work. Let me ask a couple questions. I know there's some talk about some severance tax reform for this session. Is this one of those things that I'm not real sure who you all are pushing or pursuing for this legislative session?
In my role at LSU, I am not going to lobby or push any specific bill. My role is to answer questions, and when a set of questions is asked, we answer those to the extent that we can. And so we were asked to make recommendations based upon specific criteria, and that's what we've done. And so to the extent that there is a bill that comes from these recommendations, I'll be happy to come to the table and answer any technical questions. But no, I will not be explicitly supporting or lobbying for any piece of legislation, for or against any piece of legislation.
Okay, because I'm just trying to figure out where we are as we approach, because it sounds like you've done, and I know how long you've been working on this, because you and I have been talking about this for years. But there's some feedback you're getting from industry, and of course, if their industry is giving you feedback, it's probably related to what their members and some of the oil and gas companies are surmising. And so, and then I saw y'all responded to those questions. I'm just trying to, can you summarize, or are you making some potential incorporating some potential changes on your recommendations based on what you're hearing from industry, or are you kind of, hey, this is where I think we should go, and I'm kind of where I think we need to be.
So if industry or anyone has technical changes that they would like incorporated, if a member with a specific bill comes to us and asks us our opinion of how those could be incorporated, we will be happy to do so. But no, I think it's out of our role to then take those comments back and then try to redraft or sort of negotiate that legislation. I think that would be a sort of a step beyond what I see my role in this process. So I would leave that up to a member. If a member has a bill, which I haven't seen one filed at this point, but of course, pre-file deadline's not there yet, then we'll be happy to provide any input on that and work with industry, work with the member, but that will be at the request of the member at that point.
Okay. Man, I don't know. Maybe this is a question for staff, but I'm just thinking through this, and Ms. Heavey, you may be able to weigh in. I mean, is this something that would require multiple instruments? I see, some tax decrease, some tax potential in terms of rate going up, and you've got both oil and gas that you would be, I guess, fooling with those sections. Could this all be done in one instrument, or would this require a package of instruments? And the only reason I'm asking is because when you start having different bills and they all have to tie to each other, and what if one gets moving and the other gets stalled and that sort of thing. So I don't know if you can enlighten us with that.
Sure. So, I mean, it is my opinion that this would be a single object if you went ahead and did the recommendations. If essentially, if a member were to go ahead and take the recommended, the legislation that met the goals of the study, which is what Dr. Upton has presented. If that would be a single object, you could do it all in one bill. Because of the increase in the gas severance tax rate, is not an instrument that could start in the Senate, because there would be the object of raising revenue, and so that would not be an instrument that could start. So a House member could author this legislation. But that would be, yes, it could be a single object in a single bill.
And I guess it's another way of saying that this would require a 2/3 vote, in your opinion, right?
I think if no one has made me the Secretary of the Senate, but it would. I think in the belt and suspenders, I would certainly think that would be what the Secretary and the clerk would say.
Okay, that answers.
If that turns out, I will circle around with the Secretary and get her opinion on that, and if that is, and let y'all know.
Okay, that answers my questions, Mr. Chairman.
Mr. Sheffrin, did you still have a comment?
Greg, early on, you and Jim had talked about some funds going into a trust fund. Did any of those ideas surface in your work?
Okay, so we read the resolution very carefully, and we made the decision that was not something requested in the resolution. So it's still something that's very of interest to me. I think would be a great thing to look at. But no, the idea though to expand on what the background is, could we in some way take some money from severance taxes and put them in a permanent trust fund? And there are a lot of different states and countries that do this. Norway is the notable one, that they have the largest sovereign wealth fund in the world, and it's funded by oil and gas resources. And so you could do something where, in year one, you put some small percentage of severance tax revenues into this trust fund. It's invested. And then every year, some percentage of the value of that trust fund would then go into the general fund. And then over time, that would grow as that percentage increased. So we did talk about this a lot, and I even ran some simulations on what that could be, but it didn't make it into the study just because we thought it was a little bit out of what was being specifically requested. But someone should ask us. That'd be a fun thing to look at.
Madam Secretary?
Just comments from Dr. Richardson, just to clarify, the Edwardian logic was driven by the market. The interstate natural gas prices were fixed and controlled, but not intrastate. So Governor Edwards the first Governor Edwin that is, did have some market conditions controlling his logic. He wanted to point that out, Dr. Upton. He's kind of like, Genie sitting above and texting things to be
Thank you,
pointed
Dr.
out.
Richardson. Appreciate it.
But, and just a few things, while these recommendations do consider, and reading your responses to Lamoga and Loga, you continue to point out that you are proposing to run two separate severance tax systems by continuing the existing system for those wells that have already been drilled, and the exemptions for those wells that are subject to those, and then the new system for new drilling. As the secretary, I say no. We will not have two sets of severance tax returns, because my fellow member up there, who is a CPA and a tax lawyer, knows that his clients will file the wrong return for the wrong well, and they will mess everything up. So while companies may have started out under one system, in the long run, it will make much more sense to only have one tax system. Even though they may pay a different rate in the future on a well that is already producing, trying to figure out which well goes on which form and who, that is tax administration at its worst. So we will not endorse that idea at all. And we will not encourage that legislation. And Mr. Cole is not going to want those cases to come before the Board of Tax Appeals as to why there should be interest or penalty associated with filing on the wrong form repeatedly for the taxpayer that just says, I don't have time to figure this out. I just file on this one. I don't want to file the new one. It's much easier.
So, oh, I'm sorry.
Only one.
Only one. So for point of just clarification is that how we propose it, how I see it, is that there's going to be one system, but it would just be a different tax rate depending upon when the well was drilled. So you will move all to a volumetric rate for every well, no matter when it was drilled, and that volumetric rate would be published by the Department of Natural Resources. And then the question would be, is that well at the pre-tax rate or the post-tax rate?
And so you just apply a volumetric rate to oil at the time and place, except that one is value-based and one is volume-based.
So in our proposal, all oil would go to a volume-based on the same day.
So you just have to calculate the equivalent of 12.5% at all times, all year.
So under the proposal, the Department of Natural Resources would publish a volumetric rate for oil and a volumetric rate for gas. And there would be wells drilled before that date and wells drilled after that date. And then Department of Revenue would then just apply that volumetric rate to all wells. So the value basis, when the new system were to change, would no longer be in place for any well. Everything would be on a volumetric basis.
But that's not what you reply to people about wells that were drilled before that are entitled to the incentive and everything else.
So the incentives will sunset, and the tax rate, so how it's written in it.
Except for those that already have the incentive. Put up one.
So regulatory units that are currently utilizing an incentive, those units will be grandfathered in until 2030. Okay? New regulatory units that are not currently using the exemption, they will not do it. So in the same way that right now a well gets, the Department of Natural Resources says this is a horizontal well, and they give that to revenue, it will be the same thing now where it'll be up to the Department of Natural Resources to tell revenue, yes, this is a well that qualifies for the exemption, and then you would just apply that exemption. So I believe, hopefully, that the complication on revenue side is actually going to be way simpler after we move to the volumetric rate. I hope so. We can discuss more, of course.
Sounds clear as mud that we're drilling through.
Secretary Robinson, you,
I'm done.
okay. Thank you. Ms. Calhoun? No? Yeah, let me try that.
Can you hear me?
Try that.
Great, okay. So in Mr. Angelico's defense, he wants you to know that all of his clients will always use the right return. But, so this is kind of a basic question. I just want to understand, fundamentally, the reason for changing things around, or basically simplicity after sunset provisions, I guess, would expire, and then the perception of fairness for oil producers. Are those like the two reasons that that your report is recommending these changes? And I guess to Mr. DeQueer's question earlier, is the oil production industry promoting this change? Like who really wants this to happen?
So to answer the first question, simplicity, yes, that's definitely a goal. The second, in terms of perceived fairness, as an economist, I wouldn't word it that way. I would say that taxes matter, right? People look at the internal rate of return on an investment, and if that internal rate of return meets their expectation of what they'll move forward with that investment, and if not, then they won't do that. And that's definitely how the oil and gas industry looks at drilling new wells and going into new areas. And so right now, Louisiana, compared to other states, has one of the highest tax burdens for oil. And that is discouraging oil production in Louisiana. And we have one of the lower tax burdens for gas, especially if you look at horizontal drilling gas wells, because you have 2 years of exemption or well payout, whichever occurs first, and a lower tax rate. And so it's not just perceived fairness, it actually impacts the economic decisions that people make, because those tax rates go into that decision.
And I apologize because I haven't studied your report in detail yet, but there is information in here showing that Louisiana's oil industry suffers in comparison to other states as a result of the rates? Mm-hmm. Okay.
We do, yeah. So we actually take very seriously one of the questions we ask is we say, well, maybe you might have a different tax rate on the two commodities if one is less sensitive to price changes. So let's say that oil is less sensitive to price changes than natural gas. Well, then that might be an argument to say, well, we can increase the rate on that and you won't have as much reduction in production. This would be a logic that one could think about. And we empirically test that in the report. And what we find is that both oil and natural gas have similar sensitivity to those price changes. And those calculations are actually taking explicitly into account whenever we estimate those break-even prices. In terms of your other question of whether the oil industry versus natural gas industry who's pushing this idea, we met with a lot of people. I met with gas producers in the Haynesville. I even flew to Houston to meet with one of the major gas producers in the Haynesville, walk through them piece by piece of this. They've made recommendations for specific wording. I've also met with a number of oil producers, attorneys, including yourself. And so in terms of who's going to support or who's going to not support, those are political decisions that frankly weren't necessarily taken into account in our analysis. We're making recommendations based upon the economics and based upon the structure we were given at the beginning.
Okay. Mr. Robideau, do you still have? There we go.
Just real quick, after the Secretary made her comments, it made me wonder, did you, in your report, was there any consideration given to how inactive wells would be treated? Would they be grandfathered in as a existing investment, or because they had suspended activity for however long a period of time and were restarting, they would come in under the new set of rates?
Yeah, it's a great question. So the language we have in the statute, if I'm remembering correctly, is based upon a completion date. And so a completion date would be the first time the well was completed. And so a recompletion would still be under the old tax rate as it is currently written.
Okay, thank you.
Thank you, Mr. Robideau. Ms. Heavey?
I want to remind the Institute that, that Dr. Upton was given a specific set of goals. And so in the language of the SCR, which was SCR 4 of the 2018 second extraordinary session, is they were to preserve or improve the competitiveness of the oil and gas extraction sector in Louisiana, to decrease or remove the difference in tax rates from oil and gas, create an equitable system of severance tax exemptions for all wells, not just horizontal wells, hold constant or increase mineral revenues for the state, explore other reasons why oil and gas production is fluctuating in the state of Louisiana, and any changes that need to be made to increase production. So those were the parameters under which they were operating.
Thank you. Are there any other questions for Dr. Upton? If there's not, I'd like to thank you, sir, for taking the time today to come share your significant research with us. And we certainly appreciate the input of the members here as we continue to contemplate an issue that's very important to our state, and certainly be important as we go into this fiscal session. And although we don't know necessarily who, and we've not seen the pre-filed bill, we're certain that somebody will be bringing this topic, and so this is very timely. And we know you'll continue to offer input on that as we go forward. So
Thank you, Senator.
thank you very much for that.